video there. So today, Fridays, we're looking at ETFs, and a couple of folks were asking particularly around tech ETFs. They were looking for offshore and local, but I thought let's split this and let's look at the local ETFs first. Now, what I'm going to do is we basically have three of them. So I thought, cool, let me go grab the MDDs, minimum disclosure documents, and let's walk through this process of what I'm looking for when I distinguish, when I'm looking for an ETF and I'm picking it. So, I mean, what I do care about is the cost ratio, so total expense ratio, ideally total investment cost. In other words, what am I paying for it? I care if it can go into my tax-free account, although truthfully, I invest more per year into ETFs than I can put into a tax-free account. So, if it doesn't, that's not a deal breaker for me. And then the makeup of that index. And as I said, we've got three locally. We've got the STXNDQ, we've got the One Invest S&P 500 Tech, and then we've got the SYGRIR Fourth Industrial Revolution. So we'll delve into the three of them and have a look at those differences. And then what I don't care about, if they're a feeder fund, how a feeder fund works is that you would buy the ETF on the JSE in South Africa, but what the issuer has done, they're not going and buying the individual shares. They're just going and buying an ETF in Ireland or the US or somewhere like that. Makes their life easier. As long as that feeder fund isn't buying into, an issuer, Simon's less super ETF structures, as long as it's one of the better known, reputable ETF issuers. Performance is of no matter to me for a simple reason that past performance in no way guarantees future performance. So, if you come to this because you're wanting a position in the Nasdaq, that's fine. But if you come to this because you're looking for some tech exposure, well, okay, then we can manage that. And then, of course, dividend frequency doesn't matter. Is it paying quarterly? Is it biannual? Heck, maybe even an annual dividend. I'm not going to be overly worried by the frequency of that. Now, for some people, dividends matter a heck of a lot. For me, they're not. I'm not at that point in process where I'm particularly worried about the dividend, so I'm not overly stressed by that. So what you got to do is you got to go and find the minimum disclosure documents and the most recent one, and that's not always the easiest thing in the world to do. So Johan, you're asking if you can see the content of the ETF on the Standard Bank online share trading platform. The answer is no. We can find out about the ETF, but the actual contents of it, in other words, what goes into it and the like, I go to the issuer's website and I've downloaded the most recent minimum disclosure document. Now, they give us a fair bit of information. Let me ask my phone to stop beeping me with COVID stories. It tells you about the objective, etc., managers, the size. What is important is check the date of this disclosure document. In this case, 31 March. So there should be an April one, but not yet. This was the latest I could find, and that's fine. It's 6 weeks old. I can live with that. What's it investing in? So it's a feeder fund. In other words, One Invest is simply going and buying the iShares S&P 500 Information Technology UCITS ETF. A lot of jumbo mumbo there. The two things that I care: iShares, biggest ETF issuer, one of the biggest ETF issuers in the world, along with Vanguard, and it's the S&P 500 Information Technology ETF. So that gives us a sense that this is an information tech heavy ETF. The risks I get, I understand all of that. As I said, methodology, feeder, rebalancing quarterly, that all makes sense. We drive down, annual fee maximum. However, when you drive down a little bit lower, we get to expense ratios. Total investment charge 0.43. Let's make a note of that. So this is the SP 500 Tech, and TRC is 0.43. As I talked about, was it last week when we were chatting? Was it last week? No, 2 weeks ago. We're spoiled in terms of total investment costs. They really have become so incredibly cheap these days. 0.43 might end up being the highest of the three we look at today, but it is less than 0.5%. That is proper cheap. Who should consider investing? Yeah, that's just legal disclaimers. Distribution, yeah, declaration, so pays dividends quarterly. Nice, no particular concerns with that. Here's what I'm looking for. So the first thing I want to know, so obviously its holding is 100% the S&P 500. Well, that's of course at IT sector. I want to know, that's what I'm interested in, this part here. Equity allocation, industry on a look-through basis. In other words, because the holding is the iShares S&P 500 IT sector, look-through says this is 100% tech stocks. That's what matters to me here. 100% tech. We came into this looking for a tech stock, so, for tech ETF. Whoa, what it does tell me, and there's a thought I hadn't thought, was concentration. So basically, two stocks, Microsoft and Apple, and those are not bad stocks by any stretch of imagination. In fact, they're great stocks, and they've been doing incredibly well. But those two stocks are clocking up 40% of the ETF, almost 40% of the ETF. So basically, we have to view this ETF as almost a core satellite approach. The core of the ETF is Microsoft and Apple at 40%, just under 40%. And then we've got all the others, Visa. And it's weird that Visa comes in, but it's how the S&P classifies it. I would have put Visa as a financial services. They're like, yeah, but it's tech. And I get their point behind it. We can split hairs on that, but you know what? Either we like it or we don't, and we're happy with the way the different stocks are categorized or we're not. MasterCard is there as well. Intel, Cisco, NVIDIA, Adobe, Salesforce, and PayPal as your top 10 holdings. We could go in and look. I mean, obviously, there are 500 stocks in here, and we could say, well, we want a lot more insight into what those other stocks are. But they start to get really, really small. The key point here is you've got serious concentration at Microsoft and Apple at 40%. Now, that might make some of you say that's just too much for you. In my sense, I mean, ETFs are now about 56% of my portfolio. This would make up one of many ETFs I'm holding. It would therefore downweight Microsoft and Apple within my entire portfolio to a couple of percentage points for both of them. So, maybe one or two for each. So it's not overly onerous, but it surprised me. I didn't expect to see that level there. So that is the S&P 500 Infotech. I'm just trying to find its code somewhere on this page, and that would seem to be easy, but apparently is not. Okay. Performance and the like, not so particularly interested in performance. What is interesting is it's showing us relative to its benchmark. And what we do see is that it hugs the benchmark. And that's good news. You want something that is absolutely hugging the benchmark. The drawdowns and all of these sort of statistics, excuse me, are not of massive interest to me. I understand the risks involved. I understand that you're going to get drawdown periods, you're going to get collapses, you're going to get good months and bad months. Some investors will delve into that a whole bunch. Ditto with the returns. That's not what I'm looking for here. What I'm really focusing on is the actual underlying components. And then they tell you who the fund managers are or the investment managers. That's of no particular interest to me. And then they give me some market overviews and the like. And again, yes, that's not unimportant, but this is not what I'm going to worry about when I'm in particular looking at various different ETFs. What I'm still not seeing is an easy way to find the code for this ETF. Oh, that's because I'm just maybe a little bit blind. There's the code. So of the three, there's your S&P 500 Tech ETF. Let's drop to the Nasdaq 100. This is Satrix. The date is also 2020 March, and it is STXNDQ, and that is the Satrix Nasdaq. Again, they tell us a whole bunch. Right up front, they tell us Microsoft and Apple. And here, Microsoft and Apple is making up around just over 23%, as opposed to the 20, almost 40% in the other. So we've got concentration risk, but it's a lot less concentration risk at 23%. What it's also telling us is that those are two giant stocks. And in fact, if we throw Amazon into the equation, we now, so let me also add Amazon, we suddenly pop up at, can we call it 33, give or take. You'll note that Amazon didn't register in the others because Amazon is not technically a tech stock. It is I forget how the S&P classifies it, but they don't classify Amazon as tech. Facebook ditto, Alphabet pops in, Intel, and then we get some oddities, PepsiCo. And that's the issue with the Nasdaq. The Nasdaq, although it is we think the Nasdaq 100 is a tech ETF or a tech index. It is, but actually anyone can list on the Nasdaq. Any company can list on the Nasdaq. Any company can be included in the Nasdaq 100 if you meet the requirement, which is to be the biggest, one of the top 100 companies on the Nasdaq, and then the market cap weighted. So you're going to get some non-tech stocks. Yeah, they're telling us all about it. Total expense ratio 0.48. Where is my TRC? 0 to the TRC. So TRC in total is 0.48%. I'm seeing some questions coming in. I'll come back to them. We can revisit. We've got plenty of time on this one. So TRC pretty much the same as the other 0.05 difference. Again, all of that information. Here's what I'm looking for. So actually, only 47% of this index is actually IT. 15.5% is consumer discretionary, almost 8% healthcare, consumer staples 6%, industrials 2.2%, utilities under 1%, and communications at 20.4%. And that's a key point. Whereas the One Invest was 100% tech, this one is 47% tech. Communication, we can fudge that and say that comms is also tech, but technically it's not. They differentiate it from it. But you buy the Nasdaq 100 and you think you're buying a tech ETF. You're not. You're buying half a tech ETF, and then you're buying consumer discretionaries and healthcare and comms and consumer staples. That is why sector exposure is something I always run to very quickly, and I go and have a look at what is that sector exposure, because that is critically important. I need to get a sense of what that sector exposure is, because sometimes they're just simply not what they appear on the sticker. Why doesn't the percentage numbers add up to 100? Simon, I'm not sure if you're talking about the securities. That's because it's the top 10 holdings. In the Nasdaq, there are 100. In the S&P 500, there are 500 of them. So they simply don't add to 100. And if you're talking around that space there, again, there'll be some small lurkings. EJ, thank you. Did eventually manage to find it. Question from Sean, does a weaker rand make this ETF a less attractive investment? So a weaker rand, in other words, going from 18 to 19 to 20 against the US dollar, would actually benefit, because remember, these ETFs are primarily priced in dollars. So the issuer takes your ZAR, converts them to dollars, and buys either the units or the feeder ETF, if that's how they're structuring it. So what we see is a weaker ZAR will actually benefit, and a stronger ZAR will actually take take out some of the shine. So if the ZAR goes from 18 to 16 to, I don't know, 10, that'll pull the price down, and then you'll have to have the index. So you've actually got two moving parts here. One is the index in dollars, and the second is currency. Yeah, Alan, they are available in tax-free accounts. I note, interestingly, that they're not mentioning that on their feeder forms, but I'll show you the cheat for that. But I know that all three that we're looking at today are available in the feeder in the tax-free accounts. So there's our Satrix Nasdaq, and then the SYGRIR ITRIX Fourth Industrial Revolution Global Equity ETF. Very important. SYGRIR also has a Fourth Industrial Revolution Unit Trust, and they are slightly different. The ETF is completely passive. The unit trust is they take the same stocks, but SYGRIR decides what weightings to do of those particular stocks. So the index they're tracking is the S&P Kensho New Economics Composite Index. Now, Kenso launched about 3 or so years ago. At that point, they were independent. S&P bought them a couple of years back, and they made up 6 or 7 composite indices that then fit into one index that then forms the fourth industrial revolution. There is my code for it there. SYGRIR fourth industrial revolution share code. I don't need those bits there for IR. International equities, etc. I'm not finding the costs lurking here. This is also a 31 March. I'm not seeing. Okay, so let's jump as we see. So now we get to look at what those stocks are. So we've got Tesla as the biggest holding at only 2.2, Nvidia, Apple coming in at only 1.5%. L3 Harris Technologies, never heard of them. Breaker Corp, never heard. ST Microelectronics, iRhythm Technologies, and Massimo Group, not heard of those two. 3D Systems and Garmin, I do both know. Garmin's a weirdie, but I mean, I get it. I mean, I get how Garmin could be considered. And again, we can argue it, but this is the bit that's really going to matter to me. Again, your pure tech play is a modest 38%. And then comms is 6%. So in total, let's call it 44, 45% for tech. So again, fairly low. Now, healthcare at 13, industrials at 21.6. And that makes some sense there for those weightings, because some of these stocks will be classic industrial, but they might be doing drones, or they might be doing 3D or something like that. They're industrial. So you could go into it. But in terms of pure tech, simply not there. What I'm looking for is their cost ratio. It'll be here somewhere. It's going to be lower down. Market performance, fund performance, disclaimers, fees. And they don't tell us. The schedule of fees and charges is available on request from SYGRIR iTrix. Permissible deductions may include. So they not giving it to us at that point, and maybe it's higher up. We'll go have how are they calculated. Nice, but okay, let's go through this in more detail because I'm not seeing where the fees are. Asset and index tracking, distributions, semi-annual, that's fine. Portfolio, yeah, foreign exchange source. Okay, that's an interesting factoid. So their world market fixed rate at 4 o'clock EST it's Eastern Standard Time. It's about 10 o'clock our time. Exchange JSE, benchmarks. Nope, they are not telling me what my total expense ratio is, which is totally weird. So let me quickly pop there. Let me quickly grab that browser. Let me move that to where we are. And SYGRIR, let's see. It really should be on that page, and I'm giving SYGRIR the benefit of the doubt. Maybe I'm blind. If you're seeing it, because I am sometimes blind. Des, you're saying 0.46. So I'm going to take Des's word on it. 0.46%. It really should be in the MDD, and in fact, I'm very surprised it isn't in the MDD, and I'm still just assuming that it's here somewhere, and I'm simply not seeing it. But what I do like is I like this here from them, where they tell you how much is the index moving and how much is the currency actually moving. Composite index in USD. So actually, the index has not done very well at all. What has done well is the dollar, the exchange rate, and the exchange rate is truthfully, if you were investing this in dollars, you wouldn't have made any money. But I'm more interested in finding the total expense ratio. It's tracking errors. My bad. Sorry, there it is. Okay, take it all back, SYGRIR. There it is. So annual management fee 0.46, but I want total TRC, total transaction cost. That's everything. That's what you pay for everything, 0.65. Cool. So now we've got a sense of those three, and we can now go have a look-see and see what those differences are, how they fit together. Let me bring up something where we can zoom in on that. Or actually, I know where we can do that. We can pull up another page here. New slide, add text. New slide, add text. And then the SYGRIR one down there. So the S&P 500 Tech, the ETF 5IT, the TICs are all coming in at pretty much the same, 0.43, 0.48, and 0.65. So the SYGRIR is a little bit more expensive, but we're fudging over 0.22 or 0.17%. Those are not significant to my sense. To me, the distinguisher here, to me, this is truthfully an easier process than I thought. I thought there was going to be a lot more arm wrestling as to what about. We came into this, and you'll note what I said right up front here, JSE Tech ETFs compared. That's only one ETF with 100% tech, and that is the 500 tech from One Invest. 100% tech stocks, and that's because of its focus on it. So you're not getting any healthcare or any of the other bits and pieces. You've got massive concentration of Microsoft and Apple, but assuming this is in a broader portfolio of ETFs and perhaps even equities, etc., that would be managed out. And what I mean by that is, let's say you're invested 1,000 Rand, your entire invested portfolio is 1,000 Rand. That includes your discretionary, your tax-free, your retirement annuities. It's $1,000, and you go and put $100 into this ETF. In other words, 10% of your entire investable universe goes into this ETF. So you've actually only got 4% in Microsoft and Apple of your entire 1,000 Rand, because you put $100 into here. 40% of that $100, 40 Rand, goes into Microsoft and Apple, and therefore it's $40 of your 1,000 into two individual stocks. And I'm quite comfortable with that. I mean, typically when I'm buying individual stocks, managing my own portfolio, it's around about that sort of number at times. I'm putting around 1.5 to 3, sometimes even 3.5% into an individual stock. And then, of course, if it runs, it'll increase the weighting, and we'll manage it from that perspective. So the other two which we looked at was Nasdaq at 47% tech only, and then SYGRIR Fourth Industrial Revolution at only 38% tech. You might take the view that, okay, that's fine. I've got less concentration in Nasdaq, and only 33% of the three biggest stocks. In my SYGRIR for IR, my concentration was tiny. My biggest holding was only Tesla. What you want to be careful of is, you're like, well, but I want Tesla. Okay, but maybe Tesla's in the other two already. Don't know. We'd have to go dig around and look for a lot more detail than that. But you don't buy an ETF because there's one particular stock you want. You buy the ETF for the broad principles that exist around that ETF. So for me, the outcome here ends up being actually fairly easy. My sense is that the right one to be owning in this particular space, if we were looking for tech, and that was the remit I came into this presentation with, you want to be holding the One Invest S&P 500 Tech ETF. It is our only pure. The concentration in Microsoft and Apple I can live with. And remember, Microsoft and Apple themselves are deeply diverse. And whereas the other two are actually both less than 50% pure tech. Now, you can make a bunch of arguments. You could say, no, but I want some more industrial revolution, or I like the less tech angle of Nasdaq. Those are all good arguments. But remember what we started right up front, which was JSE Tech ETFs. Coming through for some questions. A silver-backed ETF. Richard, I'll get that to you in a moment. There certainly are some silver ones. I'm going to have to log in because I'm out. Instruments, you said ETF, and there are ETFs, and I think there's a silver one. Platinum, palladium, rhodium, so One Invest doesn't have. ABSA had a couple of globals, SA props, none there. Gavi, Ilby, Tracy, gold, palladium, platinum. Okay, so there's no silver ETF, and that that makes sense. An ETF physically holds the underlying asset, and the problem with silver is that an ounce of silver fits in my hand, but it's only a couple of dollars, as opposed to an ounce of gold at $1,700, platinum 900, palladium 2,000. So simply, storage costs in silver are insane, in which case it's going to be ETNs rather than ETFs. Differences, ETN, they'll be using futures contracts to get that price. So there's the new silver, that is from ABSA. And then I'm fairly thought that there might be and a Standard Bank one, and maybe I'm just not reading the codes right, SPAG, but these are all expiring in August of this year. So the point with an ETN is it has to expire. If it's expiring in August, it's just literally a couple of months ago. So let's park those. And these are all the UBS products. So your silver is new silver from ABSA. Expires in March 2042. Yowza, yowza, yowza. So that thing has got decades still to run. How does the cost of buying Satrix via OST with buying directly with Satrix? Good point. So as I understand with Satrix, it's cheaper to buy, but there's an admin fee that is percentage of the holding that you hold. So quite possibly in time, it will become more expensive. The unit is the same. The unit price, the actual ETF price will be exactly the same. The difference is going to be in terms of transaction fee. And those platforms are cheaper transaction fee, but more expensive holding fee. Mr. R or Ms. Arfanzel got that eventually. Sometimes I'm slow. It's also a smart beta. No, it is. Yeah, no, it absolutely is a smart beta versus a traditional. And the whole Kenso, and I actually chatted to the Kenso guys way back in the day when they did their product, when they first launched the index. And there's a lot of black box behind it rather than just simple, I'm a fan of, you buy an ETF, you're basically just going to take that index. It's going to be nice. It's going to be simple. It's going to be clean. As soon as we start going black box, significantly less so. Trevor, the documents I'm looking at, so I got those from each of the issuer websites. I went to SYGRIR, I went to Satrix, and I went to One Invest, and I downloaded them from those three individual websites. Now, the tricky part is, how did I know that there were three tech ETFs, and that, I mean, I know that because it's my job to know it. The short answer is that can get a little bit messy. What you got to do is go into the instruments ETFs and basically scroll through this list here, looking and finding and eventually coming across them. So I'm in the CoreShares S&P 500. So that is the S&P 500 as opposed to the One Investors, the S&P 500 Tech. The traditional S&P 500, which is the one we talk about and reference and everything else and has done very well, that is across sectors and industries. So that's way wider than just the tech space. That can include consumer discretionaries, it will include financials. And those indices run at about 20 to 25% tech, about 18 or 20% banks. EJ, how would it compare if you bought the feeder funds, iShares on the overseas platforms, TRC? Have you considered benefit buying? So typically, so short answer, it will be cheaper. Your total expense ratio will be cheaper. And here's why: because we've got two layers of costs. iShares is charging a fee, and then whoever's doing the feeder fund comes and buys it, and they put their own fee on top. So it will be cheaper in the sense of if you go and buy it direct. In terms of the total expense ratio, transaction fees also typically cheaper. Brendan, New Silver ETN, thank you very much. You folks are way ahead of me in some terms of this. Holding fees on ETFs. So there's going to be holding fees in two different places. The first holding fee will be what we were talking about, where we mentioned the total expense ratios. So that is the fee that the management company, the issuing company, charges, and they take that fee out of the dividends which they pay to you, and that's their fee. And I've gone the total expense, TRC, total investment cost rather. So that's their transaction fees and everything else. And we can see here, 0.43, 0.48, and then 0.65. So cheap. I mean, those are cheap numbers. There is a second holding fee, which is the platform which you are on. So online share trading charges you a monthly admin fee, waived if you do 3 transactions. Some, such if you go to Satrix, they charge you a fee, a percentage based on the value of your portfolio. I hate admin fees, and I'm being polite here. I hate admin fees that work on a percentage of my portfolio. That, if my portfolio is $100, or if my portfolio is 100 million, or if my portfolio is 100 billion, the cost is broadly the same. Why are they charging me factoids more? So I appreciate that when you're a small little account, you want to pay a percentage. But there comes a point when, frankly, you just want the flat rate. Trevor, email address Simon at justonelap.com. If you go to simonbrown.co, my contact details are there. But Simon at justonelap.com, ONE and .com. Do ETF of Proteum and any ETF of Proteum management you think is showing promise? Johan, Protea management, as I understand, and I think that is Jean-Pierre Fuster's fund, if we're talking the same people, don't do ETFs. I think he's got some unit trusts, but mostly he focuses on the hedge fund business, and I haven't delved into them. Nelius, which has the highest concentration of Amazon? Good question. Don't know the answer. So S&P 500 stocks weightings. I think it's going to be the S&P. Yeah, that's not what I'm. There we go. Alphabet, Facebook, Berkshire, Johnson, Visa, JP Morgan, Procter and Gamble. Why is Amazon not on the S&P 500? How is that even? Because I missed it. So Amazon is third, and it is weighting as 4.25. And certainly compared to the 3 we just looked at, Amazon is, and that was my expectation, that Amazon was going to be the biggest there. If we go back to these 3 here, Amazon doesn't make top 10, so it's sub 1% in the fourth industrial. In the Nasdaq, Amazon pops up at, oh no, it's fairly chunky there. Oh no, Amazon. So Amazon in the Nasdaq is almost 10%. That is going to be your biggest weighting. There might be some more bespoke niche out of the US, not that I'm aware of. Trevor, would you get the Satrix Divi ETF with pandemic and companies holding back dividends? No, because how the Satrix dividend works is that it looks at forward dividend yields, and those dividends are disappearing faster than you can say Bananarama. So no, so it's very much when dividends are expanding, I tend to like that, but when dividends are contracting, I don't. And that is non-scientific, so I might be wrong. But is there a minimum amount to invest in ETF on OST? Des, no, there is no minimum. However, there is a cost effectiveness because there's a minimum brokerage. You either pay 110 or 0.5, whichever is greater. So if you invest $200, you're going to pay 110 brokerage. If you invest 20,000, you're going to pay 110 brokerage. Rob, does an average number of daily trades influence your choice of ETFs? No, it doesn't, because we have this beautiful thing called a market maker. ETF 5IT. And the market maker is constantly in the market buying and selling. So where is my market maker here? I'm thinking it's probably selling at their buying at 1050, selling at 1076. But there's the potential to trade there. So I'm not stressed by the lack of volume going through. This ETF today has done 49,000 in volume, value traded just over 500,000. It's a little bit light. I mean, Naspers did 1 billion ZAR in the closing auction yesterday. But if I want to get in or out, there's plenty of opportunity. So liquidity in an ETF is of no concern to me because the liquidity the market makers are providing. Johan, gotcha. Only 78 stocks, but compiled from it. Oh, that was the point. I get you. So, Johan, and here's the one vest man, so he knows this. The one we're looking at here, the ETF 500 Tech, is 78 stocks. They take the S&P 500, and I knew this once upon a time, but old age is getting compiling me. It's the S&P 500, and they haul out the tech stocks on it. So it's 78. Alan, do you have a model ETF portfolio? Can one view, track before buying? So I don't have a model ETF portfolio because I'm deeply lazy. So I used to, but now I just buy the Ash 1200. It's the Ashburton 1200. It's slightly higher TER. What I like about it is that it includes emerging markets. Basically, what I'm saying is find a global diverse ETF. So either one of the S&P 500s, there are a couple of them. Satrix have got, One Investor's got, SYGRIR has got, Core Shares has got. Core Shares also got their GLODIV, which is a global dividend aristocrat, not a high dividend payer. It uses dividends as the methodology to select the stocks. And what I mean by that, to be included in the US component of that ETF, you've got to have 25 years of dividend history. So no Amazon, no Facebook, et cetera, because they don't have that track record. No Alphabet. Oh, Trevor, sorry, my bad. If I had the Satrix Div ETF, would I sell it now? So I'm going to give you a horrible answer to that, which is when you bought it, did you buy it as a death do you part ETF, in which case no, or did you buy it that you would hold it until the good times disappeared, in which case sure. And what I'm saying, in other words, is when you buy an ETF, make sure when you buy anything, make sure that you have you know why you're buying it, and therefore you will be informed as to when to sell it. What would you consider to be the optimal percentage in tech sector, given the sector seems to be driving the market? It's a great question, Meryl. So I'm basically running, I mean, I within the ETFs I hold, my tech holding is around 20-25% because that's the weighting in the broad-based global indices that I invest into. And that's kind of the number that I want. You're right to the point that tech is absolutely driving, but tech is driving, for example, banking efficiency. So banks are about 18 or 20% of the indexes I hold, and tech works its way into there. The distinction between separating tech and not, I think in 2020 is almost disappeared. I mean, I interviewed a company the other day who just got 100 million from the Naspers Foundry. They are aerobiotics, and they helping farmers with tech. So if you buy Crooks Brothers as a share, they're a farming stock. They use this tech for monitoring their crops. So my sense is that tech is now just everywhere. What you're talking is going to the source of the company, and I hear you. But to my mind, I find that around the 20 to 25 that I'm getting is fine. Is an ETN more risky than an ETF? So the returns are comparable level. The difference would be is that an ETF, they physically hold the underlying assets in a third-party vehicle. If something goes bankrupt, no problem. The shares are there. An ETN is a credit note. So if the issuer of the ETN goes bankrupt, well, you join the queue, and that's not going to be fun. The question is, who's issuing ETNs in our market? And it is, at this point, Standard Bank and ABSA. And frankly, if either of those two companies go bankrupt, and I'm not saying they have any chance of it happening, we have bigger problems than our little ETF holdings. I mean, we're queuing to get into Zimbabwe. Does not look like there are buyers. This is the Cloud Atlas real estate. So Cloud Atlas might be in so this is I mean, Maurice, who puts this ETF together, I mean, he set himself up for the hardest thing in the world. I don't know if those buyers at 100 units might be him. And the reason is because this is Africa real estate listed companies, excluding South Africa. So it is really, really difficult to find the stocks. Go to cloudatlas.co, drop them a mail and ask. That might be them on the buy and on the sell side because of the lack of liquidity in those stocks. And truthfully, in this ETF. Trevor, have you noticed the 6-month tab on the chart actually brings up a 3-month chart on view screen? No, I have not. Let's not look at that one. Let's look at an ETF that has 6 months of history. So, okay. That is ponderous. I will speak to techies so I noticed that they changed the time. So that is a 1 hour. You are 100% correct. I will drop Ishmael a email. I had not ever noticed that. Okay, cool. So 6 months chart is actually a 3 month chart and should either be changed to 6 months or label it as 3 months. Fair enough, Trevor. We'll do that for you. No problem. Don, effective yesterday's interest rate reduction likely to have on bond ETFs. Rates down, yields up. Yields down, price up. So it should push them a little bit higher. But these bond ETFs are truthfully somewhat messy. I usually go to the NF Gavi. So they came down, which is just exactly the inverse of what I said I thought would happen. These bonds are, I know everyone's liking them right now. If you're looking for bonds, bond investment right now, go to the government retail bonds. Government retail bonds. You have to buy directly from them. They've got a 5-year at 10%. It was yielding 11.5 in April, and that gives you a fixed zero function over the period. Trevor, yeah, okay, better yet, let's add 6 months. So we'll have 1, 3, 6, and then a year. Well, ladies and gents, not seeing any further questions coming in, and we have hit our time. We will park it there. Video does get uploaded onto YouTube. Go to YouTube, search Standard Online Share Trading. No bank, just Standard Online Share Trading. You will find the videos. And if you've got ideas or thoughts or what you want to discuss, either on the Wednesday webcasts where we do how to use the platform, or Fridays where we look at ETFs, give us a shout. Simon at justonelap.com or tweet me, Simon PB. Cheers all. Everyone have a good weekend. Stay safe. Wash your hands. Johan, pleasure. Simon, absolute pleasure. EJ, Craig, everyone else, always the best. We'll chat again next week. Have a great weekend. Cheers all.